So unfortunately, in the editing of this video, I didn't know that I had to identify my YouTube account in order to post like a longer video. So I cut the long video into two, but for the next video, it shouldn't be a problem. Um, so yeah, this video is just cut into two, and this is the rest of the first video.
What is a stock index? A stock index is a rough display of the status of a stock market, or let's say like a specific sector, as in whatever it specializes in. It could be a specialty in any um, part of the market. However, some really big examples are the Dow Jones, the Nasdaq, and the S&P 500. These are the most traded, the most high in volatility, and the most well known across America. Anyways, moving on is I will be explaining the details or what exactly is the S&P 500. So, the S&P 500, otherwise known as Standard and Poor's 500, is an index in the American market that tracks the top 500 companies that are public. Public means that they are able to be traded publicly. Um, and pretty much the S&P 500, it's like a line of best fit, if that is, I think that's a good word for it. Line of best fit of how the top 500 companies of America are doing at a certain time. The reason why these three indexes are so important and they're so useful is pretty much you can look at them and understand how the economy is doing in a very broad and general view. Next is the Dow Jones. The Dow Jones, otherwise known as the Dow or the Dow Industrial Average, is a stock index of the American market, of course, of 30 prominent companies. It's very similar to the S&P 500, but obviously since it's 30 companies, it's a lot smaller. And the Dow Jones is also the oldest um, stock index that I'll be covering. The last stock index that I'll be covering is the Nasdaq. The Nasdaq is also a stock exchange that is second place behind the New York Stock Exchange as being the biggest stock exchange in America. However, Nasdaq does have two of its own stock indices. On the screen, we can see one of them here, the Nasdaq Composite. And another one that is not shown on the screen is the Nasdaq 100. So the difference is that the Nasdaq Composite has over 2,500 different stocks. It's a very big stock index that covers so many different sectors of our economy. And some of these stocks that are in the Nasdaq Composite are also being tracked in the S&P 500 and the Dow Jones, which I've covered previously. The difference between the Nasdaq Composite and the Nasdaq 100 is that the Nasdaq 100 covers the 100 topmost stocks that are traded in the Nasdaq stock exchange. Yeah, that's the main difference. However, they're both still stock indexes that cover stocks in general. Next is liquidity. In stocks, liquidity defines how hot the stock is. So pretty much it's like how many people are actively trading and actively buying and selling a certain stock. So, of course, high liquidity means more people are on that stock. And the reason why knowing the liquidity of a stock is so important is it can affect the moving prices of a stock, because obviously if there's more people on the stock, there's more activity on the stock, then it's gonna move more. It's gonna react more because there's so many people inputting and taking on money out of this certain stock. However, liquidity is not a concept that applies to only stocks. It applies to any type of asset, from cash to stocks to cars to art to anything, any asset. Anything that can be turned into cash is can usually be measured by liquidity. Assets that are not high in liquidity are known as liquid assets. such as houses, cars, arts, and antiques. And the reason why these are liquid assets is because they take so long to um, turn into cash. Like if you have a house and you want to sell it, you're not going to sell it within the same day. You're not going to sell it within maybe even not even in the same month. Who knows? Like it might, depending on the house, it could take a long time to sell the house. However, things like a stock, the liquidity compared to a house is a lot higher. You can, depending on stock, of course, but most stocks you can sell within that day. So the liquidity of stock is a lot higher than houses, cars, arts, antiques. Something that something any asset that the market is not hot, those are usually known as the liquid assets. But you might be asking, but can't you make a car a liquid asset by selling it for such a cheap price? Of course, if you sell a Lamborghini for $200, it's gonna sell within the same minute. But you can't really define that as a liquid as high liquidity because for an asset to be considered high liquidity, the price that it's sold for must, or the price that it's being converted into cash to, must be near market price. So let's say a Lamborghini. Just because you sell it for $200 does not mean it's high in liquidity. You just sold it for an insanely good price. However, if you're trying to sell a Lamborghini for $200,000, which is a fair market price, there's not that many buyers. Of course, there's a lot of buyers trying to buy Lamborghinis, but the liquidity is not as high as compared to a $200 Lamborghini. So, yeah, it must be near market price, which is a very important requirement. So, dividend yields. What is a dividend? Pretty much a dividend is an amount of money that you get paid for having a stock, and you can pretty much calculate how high your dividend yield will be with a very simple formula. You divide your annual dividends per share, which is already calculated for you, and you divide by the price per share, which is also already calculated for you, and you multiply that by 100, and that is pretty much your dividend yield. And it's pretty much helpful for when you want to see how profitable you'll be when you're holding a stock, which is always a good thing to know when you're investing, because you're investing to make money. I mean, of course, everyone's reason why they invest is always different. Okay, now moving on to ETFs, or otherwise known as exchange traded funds. So pretty much an ETF is an investment that is a group of multiple different assets, and these assets can include stocks, but it can also include future contracts. It can include bonds, currencies, and their commodities such as gold. And ETFs prices fluctuate all day throughout the day, and I'll be explaining a very high in liquidity ETF that is one of the most traded ETFs on the market currently. ETFs are a very good viable option for investors because it's very safe. And the reason why I say it's so safe is because it's not only stocks. It's so many different types of investments into one that even if one goes wrong, the other ones can still hold you up. And let's say you wanted to invest in, like the things I said earlier, like each of them individually. If you want to invest like each single one individually, or let's say all the stocks that an ETF holds individually, it would cost a lot more because there are commission rates that go with buying stocks, selling stocks, and you don't really want to get caught up in that. So a lot of pretty passive investors go with ETFs, which is a very, very safe option. SPY is the ETF of S&P 500, like I mentioned before, and so you might be wondering, what are the three letters on every single stock? Not always three, but 3 to 4. Like Microsoft is MSFT, which is 4. These are ticker symbols, and pretty much what ticker symbols are is pretty much like the logo, or it's like the symbol for what the company stock is. So for S&P 500's ETF Trust, it's called SPY, and this is one of the most traded ETFs, and it's used a lot in options trading, which is a totally different video that I'll be covering in this same course. But yeah, it's just something to know. Mutual funds. These are very similar to ETFs. However, the only downside with mutual funds is it can only be bought at the end of the trading day. However, ETFs can be bought whenever throughout the trading day. It can be bought from the very beginning to the very end. It does not matter. However, depending on what you really want in your investment strategies, you can choose to invest in either one. For example, if you want a lower investment minimum, ETFs are a lot better because mutual funds require a little more of an investment than ETFs, but ETFs is a very low entry investment. If you want more control of your trades, ETFs are also better because, like I said, it's traded all day, unlike mutual funds, which is definitely not good for control. And well, if you want to invest in index funds, both are pretty good because they both still include that in their funds. However, if you want the same investment to be repeated over and over and over again, mutual funds, I believe, is the way to go. And that is it for my first video on stock investment. It's a very general, quick-paced concept video, and I'll be going a lot more into detail over these next couple videos, and I hope you guys stay tuned for the next few videos. Thank you so much.